Okay, what if I told you that you could actually lose 60 out of every 100 trades you take and somehow still walk away with a massive compounding fortune? I know, it sounds like a complete paradox, right? Because, we're conditioned from a young age to believe that being wrong means you're failing. But when you get into the markets, that logic gets completely flipped on its head. So today, we're diving into an explainer of the risk-to-reward blueprint. We're going to unpack the exact mathematical edge that lets institutional traders absolutely dominate the market even while losing more than half the time. So let's dive right in and shatter some of the biggest illusions in trading.
So, can a 40% win rate really build a millionaire? Well, look, most retail traders, especially beginners, are completely obsessed with their hit rate. They'll search endlessly for some kind of magic indicator that promises an 80 or 90% win rate. But here is the brutal truth we're extracting from our source material today. Win rate alone is literally meaningless. Just picture a scale in your mind right now. On one side, you've got win rate, and on the other, risk-to-reward ratio. If you actually look at the hard data, that risk-to-reward side just drops down like a rock. It carries absolutely all the weight. Let's look at how this plays out in reality. This brings us to the reality of negative asymmetry. Imagine looking at two totally different trajectories. On one side, you've got a giant red warning flashing, 90% win rate equals broke, complete with an account balance just falling off a cliff. But then on the other side, in bright green, it says 40% win rate equals profitable, with an exploding upward trend. You're probably wondering, how on earth is that possible? Well, it all comes down to that negative asymmetry. If you win 9 small trades for $10 each, but you have terrible risk management and lose one massive trade for $150, you are completely wiped out. Working twice as hard to maintain a 90% win rate for half the reward? That's just a guaranteed path to draining your entire account.
Section 1. The high win rate trap. Negative asymmetry.
Okay, let's look at Trader A. Now, Trader A boasts a 90% win rate. They win $10 on 9 out of 10 trades. That's $90 in pure profit, and they are feeling like an absolute genius. But then, trade number 10 happens, and the market turns against them. Because they're so used to winning, they just refuse to accept the loss. They pull their stop loss. They hold on to a losing position, just hoping it turns around. And finally, they have to close the trade for a devastating $150 loss. The net result of all this? They are $60 in the red. This perfectly exposes how a super high win rate usually conceals terrible risk habits. If you risk $100 just to make 20, literally one bad trade destroys 5 of your hard-earned wins.
Section 2. The 1/3 R to R mathematical engine.
So the real secret here is asymmetric risk to reward. And the absolute golden rule highlighted in today's explainer is the 1 to 3 math code. What exactly does that mean? Well, it means you always aim for at least 3 times whatever you risk. For every single $100 you put on the line, your strict, unwavering target has to be $300 in profit. You aren't playing for scraps anymore. You're playing for multiples.
And this 1 to 3 math just completely rewrites the rules of the game. Let's bring in Trader B. Trader B takes 10 trades using this strict 1 to 3 ratio, but honestly hits a pretty dismal 40% win rate. They lose 6 out of 10 trades. At $100 risk per trade, that's $600 lost. But check this out. Look at those winning trades. Their 4 wins at a $300 reward pull in $1,200. The net result? Trader B ends up heavily in profit, up $600. They lost the vast majority of their trades, yet consistently compounded their account balance. Why? Simply because their winners were 3 times larger than their losers. The math is literally doing all the heavy lifting for you.
Section 3. Executing asymmetric setups on charts.
So how do you actually do this? Here are the strict rules of engagement derived directly from our source material. Step 1, never ever enter a trade where the potential reward is less than 2 to 3 times your stop-loss distance. Just don't do it. Step 2 is incredibly critical. Place your stop-loss logically behind market structure or invalidation points. You can never artificially shrink your stop-loss just to force a 1 to 3 ratio on a trade that doesn't naturally offer it. And finally, step 3. If a setup only requires you to risk $50 to make $50, a straight 1-to-1 ratio, you must walk away. Why? Because the mathematical edge is just way too thin once spreads and commissions start eating into your profits. You have to be fiercely protective of your minimum ratio.
Section 4. Removing emotional stress.
Think about this quote, individual losses become nothing more than standard operating expenses. Think about running a traditional brick and mortar business, right? You have to pay rent, buy inventory, pay for electricity. You don't sit there and cry when the electric bill comes, do you?
No, it's just the cost of doing business. When you operate with a 1 to 3 framework, you are mathematically expecting to lose 50 or 60% of the time. Just knowing this completely defangs a losing trade. It stops you from revenge trading, it completely prevents you from over-leveraging just to win back a loss, and it builds this cold, robotic discipline. You aren't panicking, you're literally just paying your operating expenses on the way to your next big winner.
So really, the core takeaway from this explainer is a massive fundamental mindset shift. You've got to shift away from that ego-driven desire of trying to be right on every single trade. Being right doesn't pay the bills. Asymmetric math pays the bills. You have got to stop working twice as hard for half the reward. Protect your capital, focus on the asymmetric math, and just let the law of large numbers build your wealth over time.
Now, if this mathematical breakdown changed your perspective today, you definitely want to dive deeper into the sources we used. You can find the full masterclass on YouTube at The Money Blueprint. And for written technical guides plus daily market updates, be sure to check out their daily Substack newsletter at themoneyblueprint0.substack.com. I highly recommend subscribing, leaving a like, and hey, drop a comment with what your current risk-to-reward ratio is. Let's get a real conversation going in the community about how we're all managing risk. Before we wrap up, I want to leave you with one final, provocative question. I want you to take a hard, honest look at your own trading history, your own habits, and your own psychology. Ask yourself, are you trading to be right, or are you trading to be profitable? Because as we've seen today through the risk-to-reward blueprint, those two things are very rarely the same. Master the math, protect your capital, and change your edge. Thanks so much for joining me on this explainer, and keep learning.